Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about protective strategies if you have Apple in your portfolio. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at three different strategies, actually, assuming that you have an Apple position inside your portfolio. Now, within Ally Invest, one of the most widely held stocks is Apple. So the assumption would be that you had 100 shares of Apple in your account, or that you were willing to buy 100 shares of Apple. How might I go about that process? So Apple was in the news a lot last week, which they usually are. They had their big event, their product launch event, and they also had some filings that had gone against them inside the courts, a little bit to do with the App Store and their payments that they're receiving in their App Store. So overall, the stock had a fairly bad day, or bad week, I guess. Not too terribly bad, but they were down overall. So we talked about some protective strategies on that 100 shares or 200 shares or whatever might you have of Apple inside your portfolio. So one of the strategies, and I'm showing it right now, is the covered call. That means that we're actually going to sell a call against our position, bring in some income above and beyond any dividends that Apple may pay, and give you a small pillow to land on to kind of protect yourself on the downside by lowering your cost basis as to where you actually bought the underlying stock. Next, we went out and then said, well, that gives you a small pillow. It gives you a little bit of protection, that covered call does. But what if I want more protection? Well, then we looked at a protected put, where you own 100 shares of stock. You bought a put saying that I have the right to put stock to somebody at a specific price. And then we discussed the third trade, which was actually a collar. That's where we're going to combine the two. We're going to sell the call and then take the proceeds to help pay for the put. So we have a call, a covered call, if we on our position that would bring in cash. We have a protected put, which means you'd have to spend cash. And if you do a collar and you set it up right, hopefully you can get it done for even or not spend hardly any cash whatsoever. So let's see what happened with Apple stock over the week. I'm going to go and look at a 5-day chart here, and it's 15-minute bars. Now, we always tape the Stock Play of the Day on noon on Tuesday, and the markets are live. So I've drawn a red line right where the stock was at noon on Tuesday. Now, obviously, they must have known we were talking about Apple, because it actually did make that move down about 50 cents, maybe even $1 during the call. But we're going to call it right at 150. That's about when we looked at our collar strategy, our protected put strategy, our covered call strategy. As a matter of fact, I have a screenshot of the three different trades that we were looking at. Now, once again, we were assuming that you probably had some Apple in your account. If not, you would buy 100 shares. Then let me actually make this a little bit bigger so that you can see it a little better. And then we looked at buying the OC 145 put and selling the OC 155 put. So stock, when I took the screenshot, was just below 150. So we're talking about 5 points worth of upside. And on the downside, we're going to have 5 points before our protection kicks in overall. And these are the prices. You want to make note of them. The put, it was at, we'll call it 160. We'll just look at the midpoint. We'll just look at the ask. That sounds fine. 163 on the call option that we were looking to sell. We're at 117 overall. So if we look at this chart, we do see that Apple did go down. It went down about, at this point in time, we're down about 2.5%. Once again, not a big move down, but we had, that's following about a 2.5% move down from last week overall. And we kind of talked a little bit about the 140 area. We actually looked on the chart, and let me zoom out a little. So we have this trend line that was drawn all the way back in March of last year, fairly strong trend line. We were between the 20-day and 50-day, and now we've broken below the 50-day. Talked about this little area right here, and you can kind of highlight. I'm going to take my cursor and go across. You see, this is a real interesting area, and Apple had a breakout and fail right there, but it came up and touched that 140 area a couple of times. And when they did eventually break out, that's when it started making a strong move and setting new highs. So that's definitely an interesting area right around here. And that's where that trend line hits in. We can even maybe say closer to 141 maybe or so. But that's what we were talking about. What might we do going into the year end? If you own Apple, odds are that you're a little bit up on it, unless you bought it over the last week, right? So if you bought it at the beginning of the year or have held it for many years, you probably got a decent gain on Apple in general. What are some options, strategies that we can do to protect that position overall without just selling the stock outright? So I'm going to run through the profit and loss graphs, and then we're going to go and look at it inside the Ally Invest option chains. It'll be a similar thing, but we'll be using real quotes inside the Ally Invest option chains as opposed to the playbook where we're just talking about strike A and strike B, et cetera, et cetera. Okay, so here's the assumption. Your long stock. Now, inside the options playbook, I never put long stock, so I'm just looking at a synthetic long stocks. But long stock means in the profit and loss graph that I have unlimited upside and I have substantial downside. We say substantial to the downside because it can't go below zero, but that's flat out long stock. Our break even is right where we bought the underlying stock at. Covered call. Add a covered call to that position. We move the break even down a little bit, right? Why? Because we're bringing in cash. And that cash can be used to buy the stock. And a lot of people like to think of it as they've lowered their cost basis, bought it at a little bit lower rate. Now, what's the downside of the covered call? From strike A on up, we don't make any more, right? That's the maximum that we can make on that trade overall. So we're capping our upside to give ourselves a little bit of protection on the downside. So now, once again, I'm making an assumption here that we are talking about 100 shares of stock. Most call options and put options represent 100 shares. So you would at least have to have 100 shares of Apple in your account to do these strategies. If you have 200, 300, that's fine, but you have to have at least 100 shares. Then the next strategy is a protected put. Now, the covered call assumes you own the stock, and so does the protected put. The protected put says, well, you own the stock. Now we're going to move up on the break-even point because we're going to pay for this put to get protection. So from the break-even point on up, we have unlimited upside. Why? Because we own the stock. We didn't sell it. On the downside, our put option is going to allow us to put the stock to somebody at that strike price. So we are capping our downside, and we know exactly the amount that we can lose on Apple from the time that we buy that put all the way out until the expiration date. Okay, so what's the downside of the protected put? It looks really good on paper, but you got to pay for it. What's the upside of the covered call? Well, it doesn't protect you a lot on the downside, but you bring in a credit. You don't have to pay for it. So how about we take that stock position and we do both of them? That's called a collar. So then basically you're saying between the strike of the put, which in this case would be strike A in our profit and loss graph, and the strike of the call, which would be strike B, well, then I'm going to partake. I might get a little bit more upside before I sell the stock, going all the way up to strike B. But I know on the downside, I'm going to have very limited downside because I own the put. Now, with the combination of the two, hopefully I was able to get it done for a very close to even or zero, where I sold the call and brought in enough income to pay for the put. That's a lot of times a goal on a collar strategy overall, but not necessarily. You know, if anything, you are definitely limiting the cost of or lowering the cost of your put overall. So our final position would be that collar. So we went from looking at we own stock. So this would be long stock. It says long combination, but it's synthetic long stock. We sold a call. That's one potential thing. We could just sell the call. We could just buy the put, or we could do all three overall. All right. So if we run into the Ally Invest option chains, well, we see we're down at 1.5% today, or about 2 points overall. on the marketplace. We went out to the October 14th expiration. So there was about 18 days remaining to expiration when we looked at this trade. Now there's only 14 days. And I talked about on the stock play of the day that a lot of times if you're doing protective strategies, maybe besides a covered call where, you're bringing in cash, you don't have to pay for it overall. A lot of people will do a little bit shorter term, because ultimately, if you're truly bearish on this underlying stock, you should really just go out and sell the stock, right? You should just get out of it. If you're thinking there's going to be a 10, 15, 20% downturn, well, you would just want to sell and get out of the position. A protective strategy using options means we're bullish but nervous overall. So if you find yourself continuing to buy protection or put on protective positions overall, maybe you're more bearish on the stock than you think. But my normal time range would be anywhere from 2 weeks to 30 days out in time. That's about the maximum I'd ever want to do on a protective put overall, where I'm paying for it. So we went out about 18 days, trying to get us out to mid-October. Okay, so we bought the 140. Well, let me go down and just look at the strategy workbench, which is what I took the screenshot of before. Now, remember, we're assuming you bought Apple, you had 100 shares of it, or you had 100 shares in your account, at least. We then sold the 155 strike call, bought the 145. Stock was right around 150, right in that range. So now we're at 146.67. We'll call it 146.50. So you're looking at $3.50 approximately, which you would be down on that position overall. But more importantly, what happened with the options, right? If we sold the call, and I'm going to bring this back in here, maybe let's make it a little smaller if I can. Okay. So if we sold that call option, when we sold the call option, we were looking at about a 117 on the midpoint. Now we see that that's trading for about 38 cents. So we could buy and just close that out and make the bulk of that time value from selling the call option overall. On the put side, if you bought the put, it's 163. Now the put, we've gone down 3.5 points. We haven't made a ton of money on the put. It's 163. Now it's trading for 192. Let's call it up about 30 cents on the put. One of the things you got to realize that if you're buying protection, you have a deductible in this instance, right? So we're basically saying from 150 down to 145, that's our deductible. That's our maximum loss at the expiration date, right? Stock is at below 145, say 140. We can take it at 140 and put it to somebody at 145. Okay. Now, the benefit of this, though, is that as it's going down, that put will go up in value. So you really won't get a lot of bang for your buck until it gets in the money, which is the 145 strike. That's when the put will start rewarding you a little bit more for buying it and giving you more protection on the downside. But to start with, the stock is down about 350. We've made 75. Let's call it we've made about half of that movement. Let's call it about $1.50 on the protection so far. And as with most insurance, if you think about it, very rarely do you drive your car into the tree and you get your full value back that you paid for your car when you first bought it, right? You get something representative of the value at the time of the accident. So insurance is meant to just get you back to where you were, not completely replace the overall cost. And so just keep that in mind when you're doing these strategies. But we do know that with Apple, 5 points is about 3%. And if we bought this 145 strike put, the maximum that we could lose on our 100 shares of Apple would be that 5% plus any debit that we paid for the put or the collar if we did that entire strategy. So I'm getting a little bit long-winded for overtime. Usually we're done right now, but I want to show you this in the profit and loss graph. So here is the actual position. If you started out, you had 100 shares of Apple, right? So that's what the profit and loss graph would look like. The gray line is representing where your cost basis would be if you bought it today. And below that, you lose money. Above that, you make money, right? So that's representative of just 100 shares of stock. You sell the call. now watch, this is going to move down a little bit, right? Where you break even. So we sell that call option. Now we just move down a little bit on the break even at that expiration. We're going to cap our upside, but we got a small pillow to land on, if you will, if the market goes against us. So we gave up opportunity to the upside to lower our cost basis, bring in some cash now. Lastly, we add the put to that. Now we got that whole position, and we see that in our instance, that put's going to be more expensive because we didn't do it when the stock was at 150 overall, right? We're doing it as of these markets are live right now, paying $2 for the put, only receiving 37 cents for the call. But ideally, you did lower the cost of your put, but we were much closer to getting this done for even when we did put on that initial trade. And this is actually what your position looks like. Basically, you're saying I have this Apple position. It's going to go out for the next 14 days at this point in time. And if the stock stays between 145 and 150, that's fine. It gave me the protection that I wanted. It goes above 150. Well, I'm not going to play anymore. I either can sell it or I can try to roll the position. I can do something to try to avoid assignment. There is a section in the options playbook called rolling your covered call. On the downside, if it's below 145, well, I don't have to play anymore if I want to. Other things that I can do is just close out the entire collar and just remain long the stock overall. So those are some ways. Not only now, as always on the stock play of the day and stock play of the day overtime, nothing's meant to be a recommendation. I talk about these strategies a lot on year end because a lot of people got to think about how we want to clean up our portfolios overall. And there's a lot of people in this environment, in this market environment, continually setting new highs that are going to have some stocks that they have some gains on and some that they have some losses on, but it's been a fairly good market overall. So how can I protect those gains going into the end of the year? Well, these are some of the strategies and some of the ways that you can do it. Thanks for coming for the stock play of the day overtime. Please click subscribe and ring that bell, and then you'll get all of the reminders for all of the stock plays of the day. Thanks for coming, everyone.